Hey, Gary's Gulch, welcome back. I hope you're having a great start to the week. So, what is the topic for today? So, busting financial myths. And really, what I would say this is kind of tackling financial topics that are either misconstrued or they're presented without context or something like that. They're phrases and things that on face value people believe, and it's typically at their detriment that they just buy into it with a surface level kind of phrase that you happen to hear, a little tagline. You know, a good friend of mine, Todd Langford, actually Kim's husband, says all the time, and I don't know that he made this, I don't think he made this up, but he quotes it all the time, that a lie can travel around the world before the truth gets its pants on. Meaning that, it's lies are typically, not necessarily lies, but misleading kinds of phrases, phrases that come with an agenda behind them. Are very fast to be put out there, right? Just think about the incorrect headlines that are, flashy, sensational, that gets everybody all riled up, and then you figure out, okay, that's not actually even true. But it got everybody riled up because it traveled the world before the truth got its pants on. So, you hear that happens a lot, where people will take something at face value or surface value, and it turns out wasn't in their best interest, it didn't apply in their situation. So I'm going to try to bring those things into a little better focus so that you can understand them. So here's one that we hear all the time. It has to do with different kinds of life insurance, right? So one that you'll hear is that whole life insurance is too expensive. So if you weren't on video, you didn't get to see me do the Austin Powers, quotes. And the reason I say expensive is because certainly the premiums are higher for whole life insurance. The question is, does that make it more expensive? So saving money for your upcoming vacation is more expensive than just spending it on McDonald's this weekend. But when you get out there and you no longer have the experience of that amazing vacation with family that's going to, be something that you remember forever, like our recent trip to the Galapagos that I never would have personally saved the money to pay for. Not that I don't save, but I wouldn't have focused it on that because it's just not how my brain is wired, unfortunately, because I can tell you that it was far more value than we paid for it, because I will remember those moments, those incredible experiences in nature and alongside friends with a nice cocktail in my hand, watching the sunset. I will never forget those experiences. Far outweighs anything that I paid for it. Again, it's not my way of thinking, so thankfully my bride and my good friends always kind of nudge me to go do the next great experience. And we have them on the books for 2 or 3 years into the future now, which is pretty awesome. But my point is, saving or committing additional dollars out of your budget for something doesn't mean that it's expensive. So if you look at whole life insurance and our push to help make sure that you're liquid, like to the point of 15 to 40% of your net worth is liquid in a place where it's guaranteed to always be there as a foundation for your family's future wealth and your current wealth. It gets you out of a bind when the business has a big expense, when the real estate property has a big expense, when you lose your job. And it also presents opportunities. When there's something you can buy for pennies on the dollar, well, the only person who's buying it is the person who is prepared with liquidity and able to go pull that trigger. Sometimes people think that if they have access to capital, that will work. Well, anybody who went through COVID and wanted to get access to capital from a bank during that crisis was probably unable to do so. And so, people say the same thing about having a line of credit on their house. Oh, I always have access to it for like 10 years. No, you're thinking about that backwards. They will only give you access for a maximum of 10 years, but every day when you pick up the phone or go into the bank and ask for that money, they have the right to say no. And it will be during the times when you need the money that the liquidity is not there. So thinking that you're going to pounce on opportunities with liquidity of other people's money is a mistake. That typically is not available. Again, the whole reason that opportunity is there is because the world is in crisis, economically or whatever. And crises prevent people from wanting to lend out their money to others. So the bankers were not lending in March, April, May of 2020 during the early stages of COVID. They didn't know how many people were going to die. They didn't know what was going to happen to the global markets being completely shut down, and have never experienced that before. Not even during world wars did we completely shut everything down. Didn't know what that was going to bring. Banks were not going to lend. Private equity was not lending. And so if there had been really good opportunities, which there were during that period, people who needed liquidity that didn't save their own liquidity, you could have gotten some really good deals, but you weren't going to use other people's money to do it. So yeah, maybe whole life insurance has a higher premium, a higher commitment to save into that environment, but it's not a cost. That's where people get it wrong. They think that because whole life insurance premiums are higher is that they cost more, that there is more expense there. And there's far less expense over your lifetime with whole life insurance than you will find with any universal life insurance product. Guaranteed. So, anyway, so whole life insurance is not more expensive. It's just a higher commitment level. Just like, walking into a casino and there's all these poker tables and one of them is a $2 minimum. And then there's one that's private access only. In the line between the two, there's $10 minimums, $100 minimums, $1,000 minimums. The game is not different. You're just committing to play at a higher level, right? That's often what whole life insurance does. Because, for example, index universal life insurance, you can choose to contribute nothing to it. Guess what happens when you do that? It falls apart. So, if the premiums are lower with some product other than whole life insurance, that means that there's no guarantees, and historically they do not perform. There's a myth that the performance is higher for universal life insurance, like indexed or variable, where the money's actually in the markets. If you take higher risk and put your money at risk of loss, which both of those products do, then you should definitely be promised a higher return than something that's safe, liquid, and guaranteed to be there, right? Why else would you take that risk? Again, though, I will tell you that historically, over somebody's lifetime, those products do not outperform on a consistent long-term basis because the insurance company has the ability to play with some levers for their own benefit. They can raise the premiums on the life insurance. They can increase the costs. They can increase trading fees. And, of course, the market can go backwards, right? Now, people will say that you can't lose money due to the markets and an index mutual fund. But actually what they make that phrase see and what they hear when they're first told it is that you can't lose money in an index universal life insurance policy. That's not true, because an index universal life insurance policy is an indexed mutual fund tied to a life insurance policy. And so if the index mutual fund does not earn any money that year because the markets were negative, okay, that's one part of it, but there's a cost of insurance there. And so the value of your policy will go down in years where the market is negative. So make sure you understand the whole phrase. That's another one of those, I heard what I wanted to hear and it traveled around the world while the truth was getting its pants on. If your index universal life insurance policy is indexed to something that was negative that year, you didn't get any positive return from that, which means you did not offset the expenses of your policy, which means you lost money in that account. And then how is it that an IUL policy can show you a wonderful return of 8.5% or 9%, like I saw from a client over the last 3-year average for them, and the account value did not go up by as much as they contributed? How is that possible? Well, because the insurance company's got a lever they can pull on to adjust the fees and costs of the policy and make themselves profitable, even though they're showing some very glamorous gross returns, meaning before they are able to play around with what they take out of the policy. So just be very careful with those products that don't have guarantees and have variable things like the amount of money that the company wants to put in their own pockets going forward. Okay, what's the next one? Buy term and invest the difference. You will earn more in the markets, and the term insurance will cover the protection side. So we've talked a lot about those two parallel paths, the protection path and the wealth accumulation path. And yeah, it's true on face value that if your money in the markets goes up every year and you can count on it outperforming your savings account or a life insurance policy, sure, that's great. Here's the differences though. It's not guaranteed to go up like that, right? And what actually matters about how much money you have and the liquidity you have is that it's there on the day that you need it. I've told my story on this podcast many times about how when I wanted to retire from the military as soon as I was finished with command of my submarine, that so that I could go spend time around my young sons, I was unable to do so because the money had lost half of its value while I was in command of the submarine. Timing matters. It's called sequence of return risks, which means that when the negative years occur, has a massive impact on your future wealth. For example, if you retire and then the next 2 or 3 years are negative years, you've taken decades off of how long that money will last. As opposed to if you have really good years for the first 10 or 15 years after you retire, and then, yeah, they're negative way out there at the end when you've got more money than you could care about, that's totally different. You've taken a year or two off of the how long it will last, not decades. And the sequence of return also matters in a very exclamated kind of approach or perspective when you need the money right then and it has lost half of its value. Now you can't retire. You can't send your kid to college if their 529 lost half its value. All these things become really impactful at the moment, and all these phrases that you hear of, quote, you're in it for the long haul, dollar cost average, you'll make out more by getting things at a lower value today. None of that matters if when you need the money, you open the top of the box and it's not there. So it's just super important. Yes, buy term and invest the difference in the markets. Again, it should outperform because you're risking losing the money. And if you're going to put the money at risk of loss, it should outperform a safe, liquid, guaranteed foundational vehicle, tier one quality asset, which is what the whole life insurance policy is intended and positioned to do. Its job is to replace your savings account, not compete with your investments. Index universal life insurance, variable universal life insurance, is competing with money physically at risk in the markets. And it better be able to perform at that level, but it does it without any guarantees, right? So sure, buy term and invest the difference in the markets works fine, assuming you don't need the money when it's down and that you have the stomach to support potential future market performance, and that the U.S. stock market continues to do its 7% on average every year, or whatever that the current projections are. That assumes that everything's the same going into the future, that we can handle not just $30 trillion worth of debt, but we can handle $300 trillion worth of debt into the future when you're getting closer to your own personal retirement. I don't know that any of that can actually happen. I don't want to bet on future stock markets looking like they did in the 2010s and the 1990s. The second thing about that buy term and invest the difference that you need to be very, very careful about is that you can't have term insurance in the future when you're 70, 80 years old dying at life expectancy. Term insurance only works when you're young. The idea is that you will make so much money in the markets that you won't need the term insurance, that will pale in comparison to the net worth that you have, even without life insurance, if the money was in the markets. Again, it's physically possible. You can show by back testing in the 90s that would have actually played out for a lot of people. That assumes they continue to save in there, and it also assumes that you die at life expectancy, not at age 60, the year after you've gotten rid of the term insurance. So there's a lot of factors in there that, yes, it could work out. It should work out if you're taking that much risk. It should work out that buy term and invest the difference in the markets outperforms whole life insurance. But look what we just did there again. Again, we compared whole life insurance, a safe, liquid, guaranteed tier one asset, to a market asset, to something that was at risk, at the very pivotal top speculative level of the markets. Of your hierarchy of wealth in tier 4. The whole life insurance should underperform that if you're going to take that much risk to go after the other. Again, we shouldn't be comparing safe, liquid, tier 1 assets to something that's exposed to market loss, right? It's gambling up there when you're investing the difference in the markets. And this is safe, liquid, guaranteed, foundational money that you have to be able to count on. Okay, so whole life insurance is expensive. Not really. It's actually the cheapest way and the most efficient way to save and grow capital long term, assuming you have a long-term perspective, and that you're not trying to make it compete against your market speculative assets. Buy term and invest the difference. Okay, there's some things that you needed to consider there. It's possible it might work. I think VUL, variable universal life insurance, is a train wreck. Why you would ever tie life insurance protecting your family inside a vehicle that may not have any money tomorrow is crazy stuff. Don't put those two things together. That's oil and vinegar, in my opinion. Okay, new topics. What is more important, cash flow or equity building or growing wealth? Like, is it growing your net worth or is it cash flow? Well, you've heard me say that of the three elements, of the three tenets of growing permanent wealth and achieving the future you want financially, those three things are like legs of a stool. You have cash flow, super important. It's like lifeblood flowing through your body. You've heard me say that cash flow, if you have positive cash flow that's consistent and you can count on it, net worth doesn't matter. In fact, protection doesn't matter if the cash flow is not going to stop. Why do we do the life insurance protection? Because the cash flow is coming from the human, and that's obviously not guaranteed. So having things like disability coverage and life insurance, and then protecting other important things that cash flow for you, like your rental properties, those things are important because that actually protects the cash flow, right? These three elements of the three-legged stool work together. So yeah, if you could guarantee the cash flow, then yeah, protection and growing a net worth probably don't matter. But you can't guarantee the cash flow, so you have to put protection in place to guarantee it. All right, and then so I've said though that's lifeblood. If you can generate cash flow, that's the most important thing, because you can eat cash flow, right? That's what puts food on the table. You can't eat net worth. You can't eat the equity in your house. Now you can, in good environments, you can sell the house and use that to generate a lump sum of money that creates cash flow, or that buys a business that creates cash flow. So yeah, you can turn net worth into cash flow, but there's restrictions there, right? Like it's not a guarantee that you can sell the house when you want to sell it. You can probably sell gold when you want to, so that's a pretty good asset to have as net worth. But in the end, yes, cash flow is the thing. Now, the reason I'm bringing up this topic is because my wife and I got into this conversation where I had shifted. It was more of an argument before it was a conversation. But what I realized in the argument was that I had moved on to focusing on net worth, not cash flow. And I hadn't really brought my wife along with me, so kind of shame on me for that one. We both started off 15 years ago having read Robert Kiyosaki's book, and Robert's very pure in this book, Rich Dad, Poor Dad, because he's trying to teach people at a very fundamental, basic level. It's not advanced finances. It's not advanced economics. And what he says is that, he goes through this example where he goes to his rich dad and says, hey, look at what I bought. And he bought this condo on, I think it was Lanai, or maybe it was Maui. And the oceanfront condo had a negative cash flow, slightly negative cash flow. He bought it because the pro forma said he was going to make a lot of money with equity appreciation. Well, many of us out there have done that, or know somebody who has done that. We've had negative cash flow. But what does Robert Kiyosaki's rich dad say to him? He says, shame on you. How many of those can you buy if you have negative cash flow? How many times can you go do that deal? And he's like, well, not very many. In fact, at the time, he couldn't do any. Because he had borrowed money to get to where he was. And then Rich Dad said, well, what if it had a positive X amount of cash flow? How many of those can you do? And Robert said, well, as many as I can find, infinite number, right? Which is true. It's also kind of a party trick. Because can you do an infinite number of negative cash flow if they turn 2 or 3 years later into positive cash flow, or you harvest the equity from them in a good environment? Yeah, absolutely. And that's how you get wealthy. So what I was doing was starting to, because we had a solid portfolio of positive cash flowing assets, and more importantly, because my business was mature and it was positively cash flowing at a high level, I was going off and plowing money into hard assets with long-term fixed rate loans at an environment with 5, 6, 7, 8% interest rate loans where they were not cash flowing. I knew that based on the property values right now and the loan rates, I wasn't going to positively cash flow them. But I was okay, because holistically, my income and the rental properties we currently had would offset any concerns about the cash flow from the new properties. But these new properties, with the interest rates that we were at and the inflation levels that we're at, were able to scale and make us wealthy quickly. I wouldn't say quickly, but over a few years. And then you can turn around and harvest that new amazing equity that you pulled out of having very small down payment in these properties, right? And so I talk all the time about real estate being an ideal investment. And so what I mean by that, of course, is that the income, the cash flow, that's important. But so is the equity build and the appreciation and the leverage that you can get on those, right? So holistically together, it's an incredible asset. And saying that, giving up the income for that one asset and saying, I know it's not going to positive cash flow. I can absorb negative 500 a month, negative 1,000 a month, whatever it is, because my other holistic cash flow is good enough. And I will still make a tremendous amount of money by having a 5 or 6% appreciation, even a 4% appreciation, if I'm only putting 15 or 20% down. So that was my mindset. And it was working, but that wasn't my wife's mindset. And so there's a couple lessons here. Like, I didn't bring her along with me. I didn't say, hey, I've been thinking about shifting based on where we are to now focusing on negative cash flow a bit to get the appreciation and continue to purchase in this environment, get the tax benefits, store our money in a location where it's safer than putting it into these syndications where I've lost all my family's money. So all these things were solid reasons why I was doing it. I just hadn't brought my wife with me. And so what she started to see was negative $5,000 a month, negative $10,000 a month, right, from the properties, still offset by business income. But holy moly, her mindset was, what happens if your business dies, right? If all of a sudden what you're doing goes out of favor, or you get slandered and people don't want to work with you anymore, or something like that. And all of those were well taken good points. The other thing that I'd been doing in the background was storing up more and more and more tier one liquidity, right? And we had enough liquidity to run this negative cash flow for 10 plus years. That's a lot, right? And I was more than comfortable with that. If my business dies, I'll figure something out in the next 10 years to make all that be fine. Again, I hadn't spelled that out to my wife, right? Why was it okay to be negative cash flow? Now, this is an advanced way to go after real estate. I don't recommend you do it from the very beginning. You should focus on the building blocks. When my sons are getting started on their first properties, we're focusing on the building blocks. Just like Robert Kiyosaki said, if that property is not projected to give you a solid positive cash flow, don't do the deal. It's giving you a signal. The economy, the market is giving you a signal. It's priced too high. Rents are too low in that area. Vacancy's too high. Whatever it is, it's telling you that's not the deal for you to go do. All right. So stay at the basic level when you're doing that. But I just wanted to, have this conversation with you about is it a myth that cash flow is the only thing that matters? Yeah, I think so, because it's cash flow, wealth, and protection of those two assets of the wealth and the cash flow, right? Those all three matter, and that's what I help my clients do every day. Is we look at your two parallel paths. Is there a big vulnerability here we need to fix right away? And for most people, frankly, they don't have enough they don't have enough protection. They don't have enough life insurance in place to protect that asset that they have. They have the equivalent of the $1 million home that's insured only to 100K, or the 60s Ferrari worth $2 million that they've got $100,000 of coverage on, right? They are not at all protecting the valuable assets in their life, and most of the time it's the cash flow income coming from their life. But bottom line is, I work with clients to figure out, is there vulnerability, and we fix it. And then we look at, for their specific life, where do they sit with respect to cash flow, net worth? Are they out of alignment? For example, maybe they have very thin cash flow. They've got $5 million, but it's all in their primary residence, and they can't get access to that equity because they don't have enough cash flow to go get a loan. That's a bad situation. You can't eat the equity, right? They'd be in a much better situation if they had low cash flow, lots of net worth, but $2 million of that net worth is sitting liquid in savings or a policy or something like that. Now they got the keys to the castle, right? They can do whatever they want, and they're in control, and it makes a huge difference. So please, give me feedback from this episode if those two lessons so far have made sense to you. The comparison and the trade-offs of cash flow, net worth, and protecting those things. And then the one about the myths of whole life insurance is too expensive. Variable universal life insurance is a better, quote, investment. Yeah, it is, because life insurance isn't an investment, and it's supposed to be. And then buying term and investing the difference in the markets, that there are vulnerabilities in that strategy. Like timing of when the markets are up matters. Being in it for the long haul is not always the right solution. And then second, you don't have the life insurance when you're doing the buy term and invest the difference. When you're older, you don't die with life insurance in place. And so do all of your models guarantee you that you'll have more if you take that strategy out when you're dying of older and at older age with no term insurance? Do all your models work out that way? Or are you just being optimistic and saying, well, of course I'm going to die at 89.5, which is what my life expectancy is. What happens if it's 61 and you don't have the term insurance anymore? So you just need to go through all the scenarios to make sure that these decisions you're making are not just the lie that's already traveled around the world and it sounded good when your advisor told you, or did you wait for the truth to get its pants on? Okay, one more. What do we call that? An encore, right? I have one more encore. This is a conversation about, or this is the concept of return on investment versus return on your portfolio. Return on wealth. All right, so I'll call it return on wealth. Return on investment versus return on wealth. What am I talking about? Well, I'm sure you have felt really good about a market investment. Let's call it $100,000. investment that you made and it returned 20% that year. You're walking around crowing to all your buddies at the the locker room, at the golf club, or having dinner with a friend. How are your investments going? Oh my gosh, this one investment, it did amazing, right? Maybe you quietly didn't talk about the other investments in the markets that did poorly during that time. Or maybe, here's another example. So yeah, $100,000 in the markets making 20% is $20,000 return. That's incredible. But what if your entire net worth consisted of that $100,000, another $100,000 that you had in a checking account earning 0% return because you felt like you needed some liquidity, right? That's a good idea. Maybe the checking account's not the great place, but it's a good idea at least. And then you had $800,000 in your house equity, right? So you're a millionaire. Congratulations. $800,000 is in your house, and it's been appreciating over the years at 4% a year. And so on average, that $800K is going up at $32K a year. Checking account's not going up at all. And yeah, you got the $20K return in the markets this year. So your $1 million went up by 20 and 32,000, or 52,000 total. That return on your wealth, $52,000 on $1 million wealth, is 5.2% return. It's not 20%, it's 5.2. You can do 5.2 in a life insurance policy and never pay tax on it. So what I want you to always remember when you're patting yourself on the back or when you're listening to your buddy's story about how well he did with his crypto, right? My crypto went up 600%. That's awesome. How much did you have? Oh, I put $1,000 in and now I have $6,000. Oh, cool. Don't you have $1 million and you made $6,000 this year? So just always remember to think about return on investment, one specific investment, versus return on your entire wealth. How are you doing growing all of your net worth? All of it, holistically looking at it. Do you have everything apportioned in the different tiers like you need to have? And that's the point of hierarchy of wealth. We know the percentages that historically, after tens of thousands of hours with clients, are the right percentages in the right tiers so that you've distributed your assets most efficiently so that you get to the destination you want to get to with certainty. Hey everybody, thanks so much. I hope you enjoyed busting the financial myths. Give me some feedback and we'll be back next episode. I think this one's going to be with Jason Hartman on his Empowered Investor Live, and just kind of going over what we talked about at the event, Empowered Investor Live. And this will actually be on his podcast. So more coming soon. I hope that you appreciated what we talked about today. And please, as always, give me some feedback, either email on the podcast itself or just reach out to me with a text. My phone number is 860-389-7620. Reach out to me. Love to hear your feedback. And if you have some topics you want to suggest, I'll stick them on the list. It's not a huge list, but it's a growing list. Thanks so much, and until next time, go make something amazing happen in Gary's Gulch.